Housing market picked up steam in April. Ryan Wang is a U.S. economist with HSBC. Good to see you here, Ryan.
Thanks a lot. Pleasure to be here.
So the sales report we got today, better than expected. What was the most significant trend, do you think, in that report?
Well, that's right. We saw 5.45 million home sales at an annualized rate, and that's a little bit of a pickup from the 5.2 million sales that we had last year. I think there's been a couple of factors. One, earlier in the year, we had favorable weather conditions, and because home sales usually take about 1 or 2 months to complete, some of the sales that we're getting through now in the month of April probably started earlier in the year. But more fundamentally than that, I think what we're seeing is favorable credit conditions for most households. And even more importantly, it's the improvement in the labor market. Labor market turnover has been picking up over the last several years, and that's leading to more home sales.
How are we in terms of supply?
Supply comes up quite a bit. What I would say about supply is that if you look at the month's supply of homes, that's right around 5 months. That is actually, I would say, normal. It's not quite. We're not getting the level of sales that we saw during the boom years of the housing bubble. We're getting a little over 5 million sales per year. That is a normal level. And yes, home inventories, you could say they're tight in one sense, but I would say it's really a steady as she goes type of situation in terms of the supply-demand balance.
And the prices are increasing, so that is obviously positive for homeowners. Does that look to be a trend that will continue in terms of steady incremental rises in pricing?
I think so. Prices have been rising by about 5 to 6% per year for the last several years. If you look on a national basis, average prices have increased by about 30% since 2010. And as long as we continue to get growth in the job market and there's not any spike in mortgage rates, for example, which doesn't seem very likely at the moment, I think we should continue to get demand for homes, and therefore prices should generally continue to trend higher.
But what if we do get a rate increase by the Fed? I mean, that will drift down into mortgage rates. And I know people say they're historically low, but for some people, actually, 4% is different than 3.75% and can be problematic.
Well, that's exactly right. But if you think back to where mortgage rates were back in December, they were at 4%. And now they're closer to 3.6% after the Fed raised rates last December. So I have the feeling that if the Fed were to raise rates only one time this year, which I think is most likely, then we probably won't see much of an increase in mortgage rates. They'll remain low by historical standards. And with credit conditions generally favorable, as I say, I think it's going to be steady as she goes for the housing market, at least for the next year or so.
What would be the potential roadblock, again, down the line, if there was something to disrupt the recovery that we're seeing?
Well, I think it really would come from global factors. At the moment, the effect of low bond yields in other parts of the world is actually pulling down government bond yields in the U.S. and therefore mortgage rates in the U.S. So that's actually been a positive for the housing market. But there are also downside risks that are coming from international factors. So for example, the U.S. dollar has appreciated pretty significantly over the past 2 years. And that's something that the Federal Reserve is keeping a close eye on. If the dollar were to rise too much, that could slow the recovery even more, and we've already seen its impact on certain sectors like the manufacturing sector of the U.S. economy.
Well, let's hope it is steady as she goes, as you say. Ryan, thanks so much for coming in.
Thanks a lot.
I'm Rhonda Schaffler for The Street.